It was a very tough year, and unusually, when you get difficult years, there were no safe havens. So things like US government bonds or German government bonds or UK government bonds, which would normally be expected to perform well, actually didn't. They made virtually no money, and in dollar terms actually went down. Gold, classic safe haven asset, lost 10% of your money. So it was a very tough year and very difficult for any managers to make money in 2015. Again, I think for the first time in probably living memory or ever, it turned out that the key driver for 2015 was actually China. Some years back, China didn't really matter very much. Today, it's such a big economy, its markets are open to international investors, there are international flows of money, it's 15% of world GDP, so what happens in China is very important. And as we know, China is going through a major rebalancing, restructuring process. It's got a huge credit boom which is being unwound, some big structural problems, and all those came to the fore in 2015, and I think that became the key driver during the course of the year. Of course, there were other things like the actions of the European Central Bank early in the year, the Federal Reserve. Remember, we had the first interest rate tightening in December for virtually 10 years in the US, big moment in markets. But underlying all of this was, I think, what was going on in China and its impact on the rest of the world, and incidentally, its biggest impact was on other emerging markets, which really suffered very sharply in 2015. Too much exposure to China, a big hit to commodity markets as a result of China's falling demand for commodities, and of course emerging markets are very heavily exposed to that, and too much dollar debt. They've simply taken on too much dollar debt since the crisis. Some $7 trillion of dollars has flowed into the emerging world. Well, that's now very tough given the fact that dollar interest rates have started to go up and dollar liquidity isn't as freely available. They were the big driving factors as we went through the year, and indeed it's those factors that have rolled over into 2016. All those big factors have become arguably even more important to markets so far this year. We've had a very, very tough start to the year, particularly in equity markets, the worst start to the year in history. Very short period of time, it's only a few trading days, but nevertheless it's obviously pretty worrying. Tough start in credit markets as well, and it's those same issues that were prevalent particularly in the second half of 2015 which have rolled over into 2016. And I think the big issue this year for the developed world, which is still obviously the high proportion of global capital markets, is that these problems in China and the emerging world generally spill over into the developed world. So too much debt, clearly a slowdown in growth, structural problems, high growth levels that we're used to in China of 10% per annum over a period of 10, 20 years. They're history, they're never going to happen again. China's inexorably slowing down. Other emerging markets are going in the same direction. Some other big emerging markets are in outright recession. Brazil, Russia, others are getting close to it. Are those problems going to spill over into the developed world, US, UK, Europe, Japan, and have a negative impact on growth? There's no question that in recent weeks we are seeing a slowdown in growth in some parts of the developed world, in particular in manufacturing. And the US, which is at a very strong currency, is suffering in part also because of that. So we're definitely seeing somewhat slower growth, and I think markets are reflecting that. Very tough environment for the corporate sector, so earnings under some pressure. So all of that is building up into pretty serious concern in people's minds, and we've had this big sell-off in markets in the first few days of 2016. I think the first point to address is just where we are in the cycle. Yes, we've got difficulties in the emerging world and China slowing down. Yes, there's definitely an issue with too much credit, particularly in dollars, across the emerging world. And that's a problem that will take some time to work out. I think the other thing to reflect on is the fact that so far these big falls in commodity markets, especially oil, have actually had a negative impact on global growth. The extraordinary thing is that the cuts we've seen in capital expenditure as these commodity prices fall is knocking off about 1% of global GDP, because you're seeing just massive cuts in spending, cuts in jobs and so on. And the offsetting effect of the boost to the consumer income, which a falling oil price is delivering, hasn't yet come through into consumer spending. So there are some clear worries that are making some people fear that we are seeing a very serious downturn. We don't see it that way. Well, we've had this extremely difficult start to the year, and we have lots of uncertainties. We've talked about China, the structural changes going on there, the slowdown in growth, the unwinding of a credit boom, the spillover into commodity markets and emerging markets generally, the risk of all of that spilling over into the developed world. So that's going to keep markets, I think, uncertain in the short term, volatile through the course of the year as we get bouts of nervousness. Big question marks over what the Chinese are going to do with their currency. It's likely to weaken off further. Hopefully it'll be a managed depreciation rather than sudden falls, and I think it will be managed quite successfully. China's got the wherewithal to do that, but clearly pretty tough conditions. But against that, the developed world is not in bad shape. We'll get some growth in corporate earnings, and I think that this big sell-off is giving these valuation opportunities now across equity markets, particularly in the developed world where there's greater certainty of outcome. So falls of this magnitude, I think, are an opportunity to add to positions, and I think the developed markets will recover as we go through this year and produce positive returns for us. There are pockets elsewhere of valuation opportunity, high yield bonds which are sold off heavily. I think selectively they're beginning to look pretty interesting too. So as ever, periods of sharp downside volatility will give opportunities to add to positions. And to reiterate, we don't believe that we are the beginning of a major bear market here. The conditions don't exist for that for us. So my message to investors is stay invested through this difficult period. Use these opportunities of real big sell-offs to add to positions.